All right. So, given the times that we're living in, I felt like it was beneficial to provide just my take on the stock market as a whole and just the nature of the market, right? And the basic tenet of investing in anything is buy low, sell high, right? And I'm speaking about the market in general, or the market, but investing in anything in general, buy low, sell high. The difference between those prices is your gain, which is the point of investing, to make a gain, right? Most people in the market are not really doing it that way. They're buying high and selling low. And the reason is that they are allowing their fear and their greed, their emotion to determine their investment decisions. So how a typical investor works is they hear, their friend getting this rate of return in the market, or they hear, oh, you should buy GameStop, you should buy Amazon, you should buy whatever, whatever. And they hear about it elsewhere, their friends or family getting their returns, and their greed sets in, so they invest, right? And they're happy for a little while because the market just goes up, but then the market tanks, and they say, "Oh no, I'm losing my money. I don't want to lose all my money. I need to get out of this. I need to sell." Right? They bought up here, they sold down here, and then they missed out on when the market recuperated, which it always goes back up, right? They missed out on that growth. So if they would have just bought, rode out the fluctuation, held, they would have ended up making money eventually, right? This right here, people making people being reactive to the market rather than taking a proactive approach, is exactly why over the last 30 years, stocks have averaged a 10% rate of return, bonds averaged 6%, inflation was at 3%, but the average investor got 1.8%, right? Because they were reacting to the market rather than being proactive and taking advantage of time-tested investment approaches, right? So like, folks that I work with, folks that are calling me, hey, can I buy Amazon? Hey, can I buy this individual stock? I tell them, yeah. But if you're going to invest through me, we're going to do a long-term, well-diversified, professionally managed, and some index fund, right? We're not saying one is better than the other. We are going to have a well-diversified, actively managed, long-term, systematic strategy to investing. I am not going to gamble your money. I'm never going to be the guy that said, hey, I heard about this great stock tip, you should invest, because when you end up losing money, that's my fault. Right? So the type of investing that I do for myself personally and how I help my clients, it takes advantage of some time-tested investment approaches. And the first is diversification, right? And when I say diversification, I'm not you owning 5 or 10 individual stocks is not diversification, right? True diversification is owning all the different asset classes. You're in small cap, mid cap, large cap stocks. You're in domestic, you're in international, you're in emerging markets. You've got some fixed income in there, some bonds, maybe some AAA high rated bonds, maybe some high yield as well, some lower rated bonds. You're in all different assets. You're in all different sectors of the economy, right? Consumer staples, defensive stocks. You're in technology. You're in energy. When one sector is not doing well, you've got non-correlated sectors that are keeping you up, right? Then you're also in different types of accounts. You don't just have a 401k. You also have a brokerage account. Maybe you've got some real estate assets. Maybe you've got a cash value life insurance policy, right? Diversified in different types of assets that give you different benefits. Because if all your money is stuck in a retirement account that you can't touch until you're 60, it's not really helping you, during that intermediate term of life. So diversification, dollar cost averaging, meaning making a systematic investment of the same amount of money. I'm not trying to time the market, right? I'm just recognizing that it's my time in the market to ride out the fluctuation. There has never been a 15-year period from 1926 to today that has been negative. No matter what 15-year rolling period you're looking at, whether it's 1925 to 1940, 1940 to 1955, 70 to 85, it does not matter. If you invested in one year and you took it out 15 years later, you are guaranteed to make money in the market, right? There's never been a negative 15-year period. It's not about timing the market. It's about how much time do you have in the market to ride out the fluctuation, right? So diversification, dollar cost averaging, we're making a systematic investment of the same amount of money every single month. So when the market is high, we're buying less. And when the price is lower, we're buying more. Example, you invest $100 a month. The price is up here at $20 per share. $100 will get you 5 shares. When the price is down here at $10 per share, that same $100 is now going to get you 10 shares. So if the basic tenet of investing is buy low, sell high, that's what you're doing with dollar cost averaging. You're taking advantage of the low points to buy more shares when it's low and less shares when it's high. Over the long term, it ends up averaging out to have a lower cost per share. The last time-tested investment approach is professional management, because I know that we all want to be investors, we all want to be stock traders, but unless it is your job, unless you are making your income to pay all your bills by day trading, right? Unless it is your job to sit in front of a computer all day, every day, and do all the research and analysis necessary to make the right investment decisions, you're not an investor. You're a gambler. So as long as you recognize that money that you're coming home after your 9 to 5 or after working on your business and, hopping on your Robinhood or TD Ameritrade and trying to trade, just recognize that money that you are trading, you should be comfortable losing 100% of it and it not affecting your lifestyle, right? That's the amount of money that you use there. But the foundation of your plan should not be gambling with individual stocks. It should be investing in a systematic long-term approach with a well-diversified portfolio that you buy and hold for the long term. Right? And if you can have some professional management, some people whose job it is to sit in front of a computer all day, every day, who has a team of researchers and analysts helping them make the right investment decisions, you may want to take advantage of that as well, right? Because even me personally, I'm not a day trader. I'm not a financial analyst or a stockbroker. I am a stockbroker. I have my Series 7. I'm not an analyst, right? So I defer to others. You guys are there. Here's my money. I trust you. I've done the research to know what kind of money manager and how much experience and what kind of approaches you take. You invest it, right? I'm just the one that chooses those money managers. So I hope this added value. I hope this kind of makes you start thinking about, okay, if I'm investing, if I'm gambling, I should also make sure that I'm doing that long-term investing as well, so that no matter what's going on with my individual stocks, I know I've got a solid foundation under me. And if you want some help with that, let me know. That's my job. So again, it's all love. Hope this added value, and definitely look forward to seeing what value I can add moving forward.